Tell us about what GE's doing.
Well, they are selling off most of their finance unit, and you know, this is something that shareholders have really been calling for a long time. It's something that really got him into trouble during the financial crisis, and right after that, Jeff Immelt said that you know, he's going to shrink GE Capital, and this is a rapid acceleration.
Why now? Why now?
Why now? You know, they've sold off a couple of units recently, including their Australia consumer finance business, and given the interest in that and the price they got, they figured that you know, now's a good time. The market conditions are right.
Okay, Devin, here comes the problem then. If market conditions are right,
yeah.
right? If Jeff Immelt thinks that, wow, I'm going to get high prices for this real estate, something's wrong with this picture, because that's not what Blackstone pays.
That's not what Blackstone does. I think the window we got this morning in the New York Times, Jeff Immelt gave an interview and said, look, they went straight to John Gray with this. They knew there was really only one buyer.
Yeah, exactly, right? There's nobody else to talk to.
It was on an exclusive basis, and he said they both got prices they liked. So you never know what happened behind closed doors, but there was probably some rough negotiation, and they both got prices.
That seems crazy to me. I take you back to the head of the sponsor group at Deutsche Bank, John Eidenberg, who covers all the PE firms, and he said to us, I'll never forget, people don't want to sell to PE firms because of the schmuck factor. You sell to John Gray, he wins, you lose.
By definition.
But does Jeff Immelt really lose? Come on now.
I mean, I think, as Rick said, GE had enough incentive to sort of want to sell this quickly, or at least in bulk, and that may have played a role in sort of the negotiation.
Well, and actually, there's a little bit more to it than just the market conditions. GE is a SIFI, and there's a desire on their part to
they're considered systemically important by banking regulators around the world.
They're one of the largest non-bank financial companies in the United States, and so with that comes greater scrutiny from regulators and costs that go along with that, and so they'd like to.
Now the stock is up 8%.
Hold on, Eric. Yeah. Except for the fact that that's now what Blackstone is starting to look like. The regulators just haven't noticed yet. You disagree?
No, I'm just saying that's a conversation you're going to have with Steve.
I mean,
Schwartzman, that is.
Yes.
It's not all pretty, though. GE shares are up 8%, but the company's having to pay, like, a boatload of tax on the money it's bringing back from overseas. $35 billion they're repatriating. There's $16 billion in charges, $4 billion of which are cash. Nobody should be liking that. So what are they in love with? The fact that GE's getting out of commercial real estate, not going to be an originator of commercial real estate loans any longer, and it's doing this gargantuan buyback that if they actually end up doing $50 billion, it's going to tie Apple for the largest of all time?
Well, right. You know, it's a huge buyback. This is really a move geared toward satisfying shareholders, but it's with a long-term view, because you know, there may be a number of costs right now, but they see their industrial earnings growing significantly in the next couple of years.
You know, I was thinking about this, like who's getting the right price part of it.
The money that Blackstone has, it's crazy town.
They manage what, Devin? $81 billion of real estate.
$81 billion. They've got a $15.8 billion fund coming online soon with
in
these
their free
assets.
time. They're buying the Sears Tower.
They're going to be up to about $100 billion in probably the next earnings report.
It truly is incredible. Let's go back to the pricing issue, because there is some precedent, right, for the idea that both buyer and seller can feel good about a transaction.
Yeah.
When Sam Zell sold equity office properties to Blackstone in the largest real estate transaction of all time, it's hard to imagine Sam Zell being the schmuck at the table, right? That guy knows a little bit about real estate valuation. He felt good about it. He sold it for $39 billion, and Blackstone clearly felt good about it. We know they made a killing on it, so I guess you can win-win, right?
You can win-win, and look, Blackstone has some expertise here. They could make some improvements in some of these properties. So that's probably what they're going to go for. And as Stephanie said, they have all this money to put to work. 4 funds were involved in today's GE transaction from Blackstone. I mean, you know, we talk about Blackstone.
4 funds, meaning they're splitting this among LPs?
Yeah, the money's coming from 4 different pools of LPs.
And that's why Blackstone is pretty much the only firm in the world that can do this, right?
Only one.
Like the U.S., I found this fascinating. The U.S. fund that's buying the U.S. equity assets, because there's debt involved as well, is their 8th real estate fund. They've been doing this for a long time.
That doesn't make you wonder is Blackstone. Should people take a look and say they're too big? If only one game in town globally could even possibly be the person Jeff Immelt would call, that's not an issue?
Devin?
Look, I mean, I think the argument they would make is they have these assets are spread across so many different funds, which sort of operate as individual.
That all live in the house of
You know
Blackstone.
what? Why don't we, instead of just talking about Blackstone, why don't we really get ourselves into trouble with Larry Fink, right? If Blackstone is systemically important, surely BlackRock would have to be.
Yes.
Yeah.
Now, they've all been making the case to regulators that they're not because they're asset managers and they're not principals, right? That's effectively, except in the case of Blackstone, they are principals because a lot of their money is tied up in the fund.
While Lloyd Blankfein is saying, we're just the little guys over here at the Goldman.
It's certainly the case that in the alternative asset management world, they're sort of not speaking too loudly for fear of the regulators.
They're not deposit funded, that is for certain.
No, of course.
That's one big factor.
Yeah.
And they don't really rely on wholesale funding either.
True.
To make the deals happen, obviously, they got to get leverage, but the balance sheet, well, the assets that they raise are equity assets from whomever, right?
Here's your takeaway. Size matters.